Good morning. I'm Josh Saltman, and I'm the portfolio manager for the Barron FinTech Fund. You may not have heard of Kinsale Capital Group before, but it's one of the most exciting companies in a relatively unexciting industry. Kinsale is a specialty insurance company that covers risks that are unique or difficult to underwrite. Customers can include a construction company with a history of accidents or a new restaurant in a tough part of town. These policies come with some additional risk, but also the potential for much greater reward. Kinsale's management team has decades of experience in this market niche and a track record of success. Since 2016, when the company went public, book value per share has increased by 4 times, and earnings per share have increased by 8 times. Our speaker today is the CEO of Kinsale, Mike Kehoe. Mike founded Kinsale in 2009 after serving in leadership positions at 2 other insurance companies. Mike inspires tremendous loyalty, with many of Kinsale's employees having followed him from one company to another. So please join me in welcoming Mike Kehoe.
Thanks, Josh. Well, good morning, everybody. It's great to be with you. As Josh said, Kinsale insures businesses that other insurance companies don't want to handle. And so I'm going to explain with a little bit of background information first. The property casualty industry in the United States is a large, mature industry. It's about $1 trillion of premium will change hands this year, 2023. And that market, of course, is dominated by all the name brand insurance companies we're all familiar with. State Farm and Allstate, Travelers, Hartford, Liberty Mutual, et cetera. But about 11% of that $1 trillion, so about $115 billion, falls into what's known as the specialty market. Sometimes it's called the non-standard market, or the excess and surplus lines, or E&S market. And essentially, it's a market that exists specifically to handle risks that can't find a home amongst those standard lines companies. And essentially, it's you've got your standard companies that focus on writing what we would call preferred business, low risk or good business. And so anything that qualifies as more high risk, high hazard, they typically don't want it. It drops into the non-standard market where Kinsale competes. And obviously, when you insure high risk business, hey, we have to get paid for that risk that we take. The things that make an account high risk are pretty varied. It could be a brand new business that doesn't have the requisite track record of careful management. It could be a business that's located in a litigious venue. So companies like Kinsale tend to write a disproportionate amount of our business in states like New York that tend to be much more litigious than other states. California, Texas, Florida, these are all big E&S states because they tend to be a little bit more litigious than some other states. It can be a business that, say, manufactures a high hazard product, power tools, or maybe you import children's furniture from China, or maybe you manufacture a pharmaceutical or a nutrition-related product that, if it goes bad, could injure somebody. A lot of times, it's just businesses that have a poor loss history. They just present too many claims, and so they get expelled, if you will, out of the standard market. But for whatever the rationale, companies like Kinsale use our freedom of rate and form to offset the hazard level by charging a higher price and offering more restrictive coverage. The freedom of rate and form is just one little regulatory piece that's interesting. Standard companies are subject to a tremendous amount of regulation at the state level. And typically they have to file rates and forms with the state. If they want to change their pricing, they have to make new filings. Whereas E&S companies like Kinsale operate in more of a free market environment. We can charge what the market will bear, and we can adjust coverage on a case-by-case basis, and that allows us to handle a very heterogeneous mix of business. It's not always predictable, the things we have to entertain. We recently wrote professional liability on a dentist that had been accused of sexual misconduct with his patients, and he was a talented dentist, notwithstanding his personal problems. And so we have to structure coverage in a way that, hey, we're going to insure you if you make a mistake in providing dental care. That's predictable. It's something we can price for. But we can't cover any kind of intentional misconduct. And so we'll use that freedom of rate and form to adjust the coverage to make sure that there's no way we're going to get dragged into a claim related to, sexual misconduct. And so even though we write high-risk business, Kinsale has a lot of competitors. I think there's about 75 or so companies that compete in our space. All the big companies like AIG, Chubb, Liberty Mutual, they have subsidiaries dedicated to this market. There's a lot of little boutique insurance companies that we compete with. And the largest of all would be Lloyd's of London. Lloyd's, I think, gets credited for creating insurance, maybe back in the 1600s. But Lloyd's last year wrote about 16% of all the business in the United States E&S market. So they're a big competitor as well. And I figured it might be appropriate to, at this point, just go through a few of the attributes of our business that we think set us apart from the pack a little bit, and I think go a long way to explaining the financial results we've been able to achieve over the last 14 years. We were a private company for a number of years, and then, as Josh said, we went public back in 2016. So our business strategy starts with a focus on the E&S market. That's all we write. And I think we're the only company that has that kind of focus in the marketplace. The interesting thing you should know about E&S, even though we write high-risk business, historically, the profit margins have been superior to the broader standard market. And likewise, the growth prospects have been superior. We live in a litigious world. The tort system is always changing. And E&S companies, I think, are a little bit better equipped to change with the marketplace, to, one, provide a good service to our customers in the form of competitively priced insurance, but at the same time making sure that we're delivering a strong margin for our company. We focus on small accounts really for a similar reason. There's this inexorable tendency for insurance company underwriters to want to focus on large transactions. And the reality is that as the account gets larger, the competition gets more intense, and the margins for the risk bearer get squeezed. And so we're very comfortable focusing on that small transaction. We average today about $15,000 per policy, and we think that's a very nice safe harbor. The last several years we've been in what we call a hard market, where insurance companies actually have a little bit of pricing power. Before that, we were in a very competitive market. We call that a soft market. But hard or soft market, focusing on that small E&S count gives us, we think, a perpetual opportunity to, again, serve our customers, but to generate attractive profits at the same time. And the second point here, maintain control over the underwriting and the claims management process. I think it's a little bit underappreciated outside the P&C industry how much insurance companies rely on external parties to underwrite their business. And this is especially true for small accounts because the volume of transactions is tremendous. I look at Kinsale as a kind of a boutique insurance company. Last year we wrote $1.1 billion of premium, and we had over 600,000 submissions that came in from our brokers around the United States asking us to quote the insurance on a specific risk. We sent out over 400,000 quotes. We ended up binding 40 or 50,000 of those new business policies. We bound another 50,000 or so renewal policies. And then, several tens of thousands of additional transactions like policy changes, inspections, audits, cancellations, reinstatements. We get in thousands of claims every year that have to be investigated and negotiated and resolved. And we finished 2022 with 457 employees. I would argue just anecdotally, that's a relatively modest headcount given the volume of work that's underway at our company. And I think that's the crux of why so many of our competitors outsource the small account underwriting. We think on its face it doesn't make sense. What is the core competency, or what should be the core competency of an insurance company? It's to segment and price risk. And that's an expertise, if you will, that you never actually achieve. You're always looking to improve. You're always reacting to claim trends or inflation in the marketplace or new industries that come up, like the vape business, the electronic cigarettes. They didn't exist, 10, 12 years ago. Right now they're ubiquitous. So insurance companies that are good, they're constantly pouring effort into getting better at the underwriting. But if you contract that out to, there's specialty brokers called managing general agents, MGAs. If you contract out the underwriting to an external party, it would almost prevent you from this continuous improvement. It also introduces an important misalignment of interest. MGAs, these specialty brokers that underwrite on behalf of insurance companies, get paid based on premium volume. They're sales organizations, and the sales function is critical in insurance. But we don't pay our underwriters based on volume. Their number one job is to underwrite to a profit, and their second job is to grow the business. And so we see a tremendous amount of inaccuracy in the insurance procurement process that we think stems in part from what I'll call this misalignment of interest. So we see nightclubs trying to buy insurance as though they're fine dining restaurants. We see businesses that have been in operation for a number of years that have a poor loss history, pretending to be new businesses so they can, if you will, expunge that loss history. We lost an account earlier this year. It was a very tough products liability account. It was a firearms manufacturer. We quoted the renewal policy at $170,000 premium. So for us, that's a big account. We lost that to an MGA that wrote it for $57,000. So 1/3 of our pricing. But importantly, they wrote it at the low price because they misclassified it. They considered it a sporting goods distributor instead of what the business actually did, which was manufacture firearms. So it creates a question. Number one, if you charge the wrong risk, you're not going to generate an adequate return for your investors. But beyond that, you also have the challenge of how do you manage profitability if you don't even know what you're insuring? Right? So it's a real challenge, I think, for the industry, but it goes back to these massive volumes of transactions. I had a guy at a competitor tell me a number of years ago, we can't afford to underwrite $10,000 policies. And of course, our view is you can't afford not to. But I think what he meant was we don't have the technology, the business process, the personnel, the systems to handle that massive flow of work without an enormous headcount. And of course, in this day and age, you have to be automated in how you operate your business if you're going to be competitive. And so it segues into the third thing, which is When we started Kinsale 14 years ago, we decided that our core competencies as a business are, of course, going to be underwriting and claim handling, but we added technology to that. Technology is changing, so many things about our society. It changes how we communicate with each other. It clearly changes how businesses process and accomplish work. It changes how businesses communicate with their customers, et cetera. And so, given how data-centric, if you will, an insurance company is, we felt that that was imperative for us. And so, we've built a tremendously talented group of IT professionals. Our headcount today is about 545 full-time employees. About 120 of that 545 work in our IT shop. And a few of them are focused on network security, desktop support, but the bulk of the headcount is focused on constantly innovating and rolling out new features and functions, taking manual tasks, pushing them into the software, doing all the things we have to do to innovate and get better with how we run our business. And most insurance companies take the opposite tact. They outsource the technology. It's a complex function to manage, I think, inside of an insurance company. But once you build it, it provides some very powerful competitive advantages. And just a quick anecdote. We had a young woman who was a claims examiner in our office. We're based down in Richmond, Virginia. And she left our company to go to one of our competitors in town. And of course, she still has friends at Kinsale, and she was having lunch with them and complaining about the new company she went to. Gee, the systems are a disaster. She has to go in and out of 6 or 8 different systems all day long to accomplish her job, whereas at Kinsale, she had one integrated system. And it's just a reminder that for old line insurance companies that have been around a long time, most of them have been built in part through acquisition of other insurance companies. They're all dragging along legacy software, not one system, but in some cases dozens and dozens of legacy systems that go back 20, 30, 40, 50 years. Kinsale has no legacy software. We do have some software that's dated, but it goes back 10, 12 years, not 30 or 40. And again, we're constantly rewriting our system to improve it. So I would just tell you, it's the small account E&S focus is really a positive indicator for profit and growth. Adding in the fact that we control our own underwriting is another competitive advantage that I think has real durability to it, because we get there through technology. It took us 7 years to build our own enterprise system. This is the main workhorse system that we use to operate our business. And I'm sure other people can do it. Maybe they could do it in 6 years, but they can't do it in 2 or 3. It's a massively complex undertaking. And so I think the technology also creates a durable competitive advantage. And then that segues into the fourth bullet there, which is this idea of taking a quantitative approach to the business. There is so much folklore and whatnot that governs how insurance companies are managed. And just one example of how we use data to manage the business. About 7 or 8 years ago, one of the actuaries or quantitative type analysts in our company was doing some analysis of when we bind a piece of business, right? You're sending out hundreds of thousands of quotes. We're looking to get smarter about when we bind versus when someone else does. And one thing that leaped out of the data was the quicker you offer the broker the terms, the higher the probability of a bind order. But that flew in the face of the P&C tradition, which is allowing each underwriter in the building to take his or her time to quote what they want, when they want. And so this evolved very quickly into a complete change in how we service our brokers. And we put enormous emphasis on quoting the highest volume of submissions that come in, as long as they fit our risk appetite. and then we quote them as fast as we can. And the brokers love it. We are the only company in our industry, in this E&S market, that provides a level of service that we do. And the beauty of it is we can then be more aggressive in pushing up our prices slightly higher. We can push the broker commissions we pay to our brokers down slightly. We pay a little bit less commission than all of our competitors. In many cases, we can offer slightly more restrictive coverage, which helps us drive a more predictable loss ratio. All because we give our customer, the broker in this case, a more pleasant experience. So it's a very contrarian approach to the business. It's hard to execute. It took us a number of years to change people's behavior, but it's a powerful driver, along with these other elements, we think, in helping us reach the goals that we have, the financial results we have over time. Oops. A couple more slides here. This one just kind of reiterates some of the things we've talked about, the focus on the E&S market and some of these main elements of our business strategy. One thing we haven't talked about is business culture, but culture is something, it's kind of, I think Jack Welch, the old CEO of General Electric, used to call it social software. It really does contribute enormously to how people behave in an organization, but it's admittedly hard to reduce it to a few metrics where you can compare us to our competitors. But I would tell you that Kinsale is an entrepreneurial startup company, even though we've been in business now 14 years. We consider ourselves owner-operators. We've, certainly the leadership team, but many of the rank and file employees have invested very significant amounts of our net worth in the business. We consider it our money, and we manage the company that way. I think it's a big contributor, if you will, to the success we've been able to achieve over the years. This slide just kind of captures the fact that there's a lot of diversification in our book of business. We service the small E&S marketplace. We've got 23, we call verticals or underwriting divisions within our underwriting department. And the idea of getting our underwriters to focus on either an industry segment or a coverage helps ensure that we're driving a lot of expertise at the transaction level. We talked about technology and how important that is to us. Over 20% of our headcount is focused in the tech area. And I may have omitted one thing here, but one last thing that the technology provides is an opportunity to operate at a much lower cost structure than our competitors. If you're familiar with the personal auto space, we all get carpet bombed with ads. Geico and Progressive are the two low-cost leaders in personal auto. And for 25 or 30 years in a row, they've been delivering good returns and taking market share from their competitors. 25 years ago, they were each about 2.5% of the personal auto market. Now they're about 14%. Kinsale's executing a very similar strategy in the E&S market, not personal auto. And so last quarter, I think our expense ratio, so that's all the expenses we have to operate the business, excluding losses. Our expense ratio is right around 21%. Most of our competitors that, like us, focus on the small account market are in the mid-30s. I think Lloyd's on its small account business may be above 40%. It's almost an unbelievable advantage. And in a commodity business like insurance, I promise, your customers care about cost more than anything. And so to have a low-cost structure means we can offer more competitive pricing to the business owner, but at the same time deliver better returns to our stockholders. And then the last slide here is just a look back at our operating return on equity over the last several years. And you can see that gradual increase in the profitability of the company. That's really reflective of certainly the Kinsale model, but also the marketplace we've been operating in. There's been a rise in dislocation, if you will, financial distress amongst some of our competitors. And so it's given us an opportunity to push up pricing, to charge our customers a little bit more, to grow our business a little bit more quickly, and you can see the elevated returns there. We've had a lot of inflation the last couple of years. That can be painful to an insurance company because insurance companies collect the premium today and we pay the claims out over a couple year period of time. At Kinsale, we're well protected against that because we always set aside a lot of what we would call conservative level of reserves to pay future claims. Sometimes our competitors aren't so cautious, and so it's really given us a nice opportunity in the last few years, and we continue to be quite optimistic. Josh, that's the end of my prepared remarks.
Thanks a lot, Mike. That was great. So now we're going to open up for questions from the audience. So please think of questions you'd like to ask. I guess just to kick things off, Mike, just a question about the industry. You mentioned that we're in a hard market. And I'm sure that many people in the audience are seeing their own insurance premiums go up a lot faster than they have historically. Why are rates rising so much? And how does this impact Kinsale?
Yeah, I think the principal reason is loss costs are rising. The United States has a state-based tort system. And in general, the tort system grows a little bit faster than the economy every year. And it grows in a fairly predictable fashion. And so it allows insurance companies to very accurately and moderately increase pricing to make sure they're covering their costs and generating a return. COVID was it was just a wild event from an insurance standpoint in terms of upturning predictability, right? The whole economy, not the whole economy, but I mean, a dramatic slowdown in the economy. People stopped driving to work. The number of miles driven just collapsed. The tort system also saw an incredible reduction in the number of lawsuits filed, et cetera. People stopped going to the doctor for elective procedures. And then as things opened, there's a rebound effect that was equally unpredictable. And then when you add in the fact that we've had this rise in inflation the last couple of years, I would really attribute the discombobulation in the industry, the fact that insurance rates are rising for individuals. You know, keep in mind, for Kinsale, that's good news. Obviously, you know, for consumers, it's not. But there's also a last element which is related to the weather. Depending on where you live, if you buy a homeowner's insurance policy and you happen to live on the Gulf Coast or on the southeast United States where there's a pronounced exposure to hurricane, there has been a big uptick in hurricane activity since about 2016. Multiple storms in Texas, Florida, Louisiana, and they can be wildly expensive for the industry, tens of billions of dollars, and they come all at once. And so a lot of insurance companies lost money in the rise, in this uptick in natural catastrophes. You have a similar phenomenon out west with wildfires. You know, Americans like to live on, you know, the hill looking out over Los Angeles. It's a beautiful view, but it comes with a lot of risk. And so the insurance companies in a lot of ways are playing catch up from some of these trends.
Mm-hmm. And before starting Kinsale, you were CEO of another insurance company, James River. What lessons did you learn from that experience that you have applied to Kinsale?
Well, candidly, there are a million lessons learned. As you operate a business, you know, you're constantly looking for ways to improve what you do. I would say one of the more interesting challenges of being a business manager is how you interact with people. People are, ultimately it's the foundation of a successful business. You have to recruit and retain good quality people that share your commitment to building a great business, serving the customers, et cetera. And there's an interesting balance. You have to treat people with respect. You have to be kind. I think you have to be patient. But you also have to hold people accountable. And there's an interesting balance there that I'm not sure there's a bright line rule you can reference to say, hey, this is the right way to balance the accountability with the patience. But I do think it's something that over time you get better at. Sometimes people are in the wrong jobs, and hey, we got to take somebody out of that job. But we really like the individual, and that person has a family, and maybe that's the principal breadwinner in the family. And so there's always a lot of rationale to go slowly, which is appropriate. But at some point, you have a tremendous responsibility as a CEO of a company. You're the steward of other people's money. And you can't be too myopic about just looking at the individual and forgetting your broader responsibility. Not to say I forgot it at James River or one of these prior companies, just that the experience of working at one E&S company and then going to another and then another, I think you just learn some great lessons in how to better manage people.
Great. Number 3.
Good morning. Thanks again for this wonderful conference. It's good to be back. Given your expertise in the insurance market, I have 2 questions. As a broker of a boutique health insurance agency, I'm curious about your professional opinion about health insurance in the United States. And a non-related question, but one important to the future, is how AI, ChatGPT, and artificial intelligence is making its way into your business. Thank you.
Sure. I'm going to start in reverse order here. We're doing a lot of experimenting with AI. There's some interesting and dangerous exposures that AI brings to network security. Someone could make a fake video of Ron Barron telling Josh to wire money to a nefarious account. And it may look like Ron on the video or the voicemail, but it's really an imposter. So the network security guys are very concerned about AI and what that can do to fraudsters. We're using AI in our product development area. We have a lot of quants that we employ at Kinsale, and they're using AI to test various forms of third-party data that we purchase from other companies to see if it's predictive of loss or not. Ultimately, the underwriting function, where you look at a business and you classify the risk, AI will have a more prominent role in that. But I think it's all coming in the future and gradually over time. But clearly, we're doing, I think, a lot of work to be innovative in that area. And then in terms of health insurance, the insurance industry broadly divides into 2 buckets: life and health, property casualty. So, we're on the P&C side. Health insurance has its own challenges around third-party payers. The person paying the bill is not the person consuming the service. I think that gives rise to a misalignment of interest. Obviously, new technology and new pharmaceuticals are just tremendous in being able to improve, human welfare. But sometimes they come at just staggering costs, and so society has to work through, I think, how those technologies, et cetera, will be made available broadly. Lots of challenges there, but candidly, I'm just a consumer on the health side.
How does one know whether there's a fraudulent person pretending to be me?
Well, the network security guys are hard at work on that as we speak, but I think right now the videos are primitive enough that you would be able to tell.
But they won't be for long.
It's just that the fraudsters are becoming more convincing, and they're using AI as a tool to do that. And so I think companies, not just insurance companies, but all companies, need to obviously be vigilant and work on staying abreast of the threats and making sure that they're contained. It's a little bit of an arms race, Ron.
Number 8.
Curious what has driven the volatility of the stock price recently of Kinsale?
Well, we don't set the stock price, of course. I would say this, the business, we're executing the same plan today that we started with 14 years ago. Obviously, it evolves continuously. We broaden the product line. We deploy more technology today than ever. The results have continued more or less in a similar trajectory. We've grown the business at a good clip. We've produced best-in-class returns. The stock has, run up quite a bit this year. I think even with the sell-off in the last week or so, we're still up somewhere in the mid-30% range year to date. So that's a lot of price appreciation. I don't know, maybe Josh has a better opinion on the stock.
You guys have been executing well.
I'm happy with 30.
Number
Ron's
5.
happy, I'm happy.
Congratulations on the success of the company. Kind of following up on the prior question, as you noted, insurance is a mature industry. Most P&C companies probably trade 2 to 3 times book value at best. Even with the recent sell-off, Kinsale's trading at 9 times. Why do you think that is the case?
Well, I think part of it is we manage our capital very carefully. And so we really serve 2 masters when it comes to capital. One, we have to have enough to satisfy state regulators. And then the more onerous capital standard comes from a company called AM Best, which is the principal rating agency for the insurance industry. And AM Best has, it's a complex capital model that they look at your reserves and your premium and your investments and your growth and all sorts of things and come up with an amount of capital that you have to protect the policyholders. And we always make sure we have more than enough, but only a little bit more than enough. Whereas a lot of our competitors, I think, have a real abundance of capital beyond what they need, to operate their businesses. So I think in some ways it can be that price to book value can be an apples and orange comparison. The other thing is Kinsale has generated very attractive returns and a very good growth profile for a long time now. And so I think the marketplace is rewarding us for that. And then the last comment I'd make is if you look at Kinsale's price as a multiple of earnings, of prospective earnings, I think you would find that we don't trade anywhere. We still trade at a high multiple, but nowhere nearly as high. Like we're at the high end of the range, but we're not, 4 or 5 times what other companies are.
Number 7.
You insure high-risk situations, and you briefly mentioned the disasters in the country, the fire and flood and whatever. Does that mean that your company would insure these homeowners, or would they get insurance from any company, or are these homeowners out of luck?
No, the homeowners are not out of luck, generally speaking. It's just the cost of that risk transfer is going up dramatically. And there is a segment, rather, of homeowner. If you live in a very old house, I'm thinking of Fort Myers, Florida right now. You know, you had a devastating storm, you had a very old housing stock. Older homes perform very poorly in high wind speeds. High wind speeds result in catastrophic damages. The home is effectively destroyed. Florida has dramatically improved its building codes over the year. They're the best in the whole country, by far. But those building codes are a lot more expensive than what it costs to build these older homes. And so there's a situation where a lot of those homeowners are effectively being pushed out of their homes. They can't afford to rebuild, in part because the insurance costs are dramatically higher, and in part because the building costs are dramatically higher. There is a market for the insurance. It just, for the consumers, I think it looks absurd. Hey, I was paying, I'm making this up, $3,000, and now somebody wants to charge me $15,000. It looks like just outrageous price gouging. What the consumer forgets is, hey, these insurance companies, some of them have become insolvent, right? If they didn't manage that CAT exposure, we call it CAT, natural catastrophe exposure, carefully, it will bankrupt the company. But even if the company's not bankrupted, a lot of companies in Florida lost a fortune. And so, hey, you're our stockholders, we serve you, you've invested with Kinsale because you're counting on us to be smart business people and to operate at a profit. So it's just a real challenge, I think, for homeowners in places like Florida if they're in close proximity to the beach. But there is a market.
Great. We're now out of time. Thank you very much, Mike.
Thanks, Josh.